Hello and welcome to today's podcast, the trading podcast that gives you a lively run through of the markets, what to look out for and how to improve your trading. My name is Adrian Buthee. I've been trading the market since 2002 and I'm now head of trading here at Trendsignal. And today I'm joined with Trendsignal's chief market analyst, Jerry Miller. And what we're going to be looking at today is a great number of things. We're going to be taking a look at what's happened last week, how we could have traded it, what's happening for the week ahead, the major sound bites, the major items that are going to be influencing the market and how we should be positioned, what I'm trading this week, what are the key levels of support and resistance on the pound, on the FTSE, on gold. We're going to be looking at that, and also in our defining trading section we're going to take a look at what initial margin is. So for the new traders amongst us, we're going to be getting into that, delving into some of these definitions to help you become a more educated and better trader. The overwhelming theme though today, big data out today already, where we're talking about another member of the MPC talking about potentially cutting interest rates, and we're going to be talking about how the pound will be affected if the UK does go and cut interest rates as well. But first of all, let's get into what's happening with the markets. Okay, so let's kick off then. So in this section, we're going to take a look at what happened last week, where the movement was, where the opportunities were, and I guess more importantly, how we could have known all about it before the events. So Jerry, what happened last week? Give us a run through.
Interesting first week, full week back for the markets. As everyone knows, we had the geo-political grenade thrown in the previous Friday when the US administration assassinated Soleimani, the second in command really in Iran, and it caused all sorts of issues. The markets obviously reacted really badly, and then last week we had the revenge that eventually took place after the Soleimani sort of 3-day funeral fest, and it just looked a bit stage managed. So last Wednesday or Tuesday night, they being the Iranians, attacked the Iraqi the US bases in Iraq. And they didn't kill anyone, they didn't destroy anything. I mean, I don't know what they did with their missiles, but...
Sounds a little bit weird, doesn't it? I mean, you would have thought that just for the... You could have easily just got one American, couldn't they? So
yeah,
it just seemed a little bit stage managed, as you say.
Yeah, I think someone tripped over and cut his leg or something, running away from a missile. But I mean, that was the worst of it. And it just sounded sort of stage managed. But I think in retrospect, it was probably a wise move from the Iranian regime, because all that would happen is they would have probably had some Tomahawk cruise missiles coming back, not Ukrainian passenger jets. So
yeah, it could have got a bit serious very, very quickly, couldn't it?
Yeah, it did. And what's weird is that they created a lot of sort of nationalistic fervour on the back of the Soleimani sort of funeral. But it was interesting. The markets reacted obviously negatively when the event was taking place. The revenge attack in Iraq, but it was weird. Come sort of Wednesday afternoon, Trump just said, "Hey, everything's fine. We're okay. No one's died. That's it." Well, he effectively was saying the matter is closed. And
yes, and he was talking about them. Oh, they've backed down. We're like,
yeah. Well, the Iranians effectively backed down. They didn't say they're backing down.
Yeah.
But U.S. Surveillance said that all of the sort of missile commands, etc., had gone back inside, or whatever they do, you know, they're no longer on alert. So it was an extraordinary sort of turnout. And of course, since then, we've had this whole lies and deceit around the shooting down of the Ukrainian passenger jet, which is extraordinary. Why they were letting jets take off from Tehran airport, 2 hours after potentially the start of the Third World War is beyond me. I mean, it's just bizarre.
Yeah.
But anyway, so on the back of that, obviously crude at one stage, I mean, it was sharply higher at UK oil, sort of hitting $71. Gold went up to 16.11. It was extraordinary moves, real risk off mode, where safe haven assets, etc., and commodities linked to the sort of Middle East all went haywire. Equities came off, but then it all reversed on Wednesday afternoon. It was extraordinary.
Yeah, I mean, we talked about in the definition last week, we talked about risk on, risk off, and the way that portfolios can be repositioned. But just quickly, you mentioned UK oil. So just for the benefit of our readers, UK oil, it's not really UK, is it?
No. It's called UK oil.
That's the name from the FXCM instrument,
right,
isn't it?
right.
But Brent crude.
It's Brent crude. There are two benchmarks really, WTI or US oil. WTI stands for West Texas Intermediate, sort of lighter oil, and it's more of a domestic focused oil in the US, whereas Brent crude is the world benchmark. So anyone trading oil will refer to Brent crude generally. But no, oil had it's come off pretty sharply since then, and it continues to fall now. I mean, we're got a long way all down from those sort of levels. I think crude's fallen. I know, is it sort of $5-6, something like that? It's quite a move.
It's interesting. I mean, we talked last week about the impact of terrorist events and how they seem to be sort of back in the past, the last decade, maybe the decade before, huge impacts from any sort of hint of terrorism there might be. But markets seem to be a bit sort of muted by those sorts of events now.
Yeah, they're sort of becoming immune, I guess. I say immune to the extent that the impact tends to have less of an enduring impact. So sometimes, in days gone past when you had 9/11, I mean, that was really extreme.
Yeah.
But then think about the bombs in London.
You'd have four to 800 point fall, and that was from a much lower base as well, much lower price of the indices.
Do you remember the bombs in Madrid as well?
Yeah.
But this was literally over before the day had finished.
But the funny thing about, not funny at all, but you'd often find that those terrorist events, you'd see a massive sell-off for maybe 24 hours. Then the market would be straight back where it was after that. And I think people have just realised, actually,
what's changed?
In the grand scheme of things, it doesn't really mean a whole heap.
No, that's right. What's changed in terms of those dynamics for the valuation of US companies? Not a lot. For UK companies, not a lot. And that's the way it is these days.
So, I mean, one thing we've discussed, and I've heard a little bit about with the, obviously it's the US presidential election coming up later this year, the end of November, isn't it?
Yeah.
Do you think that his decision making to assassinate Soleimani has got a little bit to do with that for Trump?
It's quite interesting. I think the window of decision making was about sort of quarter of an hour. I mean, this convoy was literally driving along a perimeter road in Tehran airport. So Trump doesn't need a lot of time to think. I'm not sure he thinks much anyway.
Nice to shoot from the hip, doesn't it?
Shoot from the hip, yeah. I think he's always felt that, previous presidents had pulled their punches, as it were, and I know Bush was looking at assassinating, getting rid of Soleimani, so he's the one that's done it, and in a way, the reaction has turned out very much in his favour. So he's managed to get away with it, in inverted commas. There's no war, there's no escalation, and they know that they just can't second guess him, because he is a bit, as you say, shoots from the hip. You don't quite know what decision he's going to take next.
Yeah.
So I don't think he'll have planned it that way, Trump. He's not that switched on. But no, it's you could say a lot of people think he's been lucky with the outcome. We'll have to wait and see. But certainly he's got an eye on the election. That's absolutely for certain.
Yeah.
And that would have played a part in that decision.
Yeah. Okay, and what about the FX markets, Jerry?
Interesting week in FX markets. I mean, the thing that's grabbing the attention at the moment is sterling. There's a report in the FT this morning that another Monetary Policy Committee member, the MPC member, this is the committee that sets rates in the UK, is now considering voting for a rate cut in the UK, depending how the economy has performed since the election.
Yeah.
So it's all brewing up. And Mark Carney, I don't you recall last week, he said that he would take swift action to cut rates if growth looked to be slowing further. So you've got two members, and then this other member, Silvana Tenreiro, he's also said he would look to cut rates. So that's three members now, and I think that starts to look like it's become a probable cut rather than a possible cut.
Yeah, I mean, certainly we saw a selling opportunity on the 8th of January, just showing it on the screen now if you're watching this podcast, rather than just listening to it. And, a nice move down. We're 100 points or so lower than the signal back on the 8th. I'm going to talk a bit more about this in the analysis section a bit later on. But why? Okay, so let's just explain it again for the listeners, for the viewers. Why would this mean a fall in the value of the pound if we're talking about a more likely cut in rates?
Yeah, okay, so foreign exchange rates, so that's the rate, obviously it's not just sterling against the dollar, sterling against the euro, sterling against the yen, whatever it might be. When there is the possibility of a rate cut or a change in rates, it will affect the value of the currency, because if you hold that currency and you're getting a lower return because the interest rate has been cut. So let's say you were getting 1%, they cut it to 0.5%. You're getting less for your money. So there's less of a reason for people or investors, traders, to hold sterling. And if anything, they will sell sterling and put it into a higher yielding currency. Yeah. So an interest rate cut weakens the currency because of the less of a rate of return that you're going to get on your money. And the problem with currencies at the moment is that all yields are really low. I mean, days when you and I grew up, Adrian, there'd be sometimes 4 or 5% between currency, certain countries at interest rates. But now you're talking about it's real marginal, but it still has an effect. Yeah. I'm not sure how long this sell-off's going to last on sterling there.
Yeah, well, we're going to talk about some of the support levels. We're actually quite close to one, probably about 40, 50 pips away from a major level of support on sterling. So listen, I'm going to talk about that a bit later. Okay, so commodity-wise, obviously some massive moves there. What about gold, Joe?
Gold, extraordinary. Yeah, I mean, on the week, we're at $11 higher, but that really doesn't tell the whole story. Just a modest move on the week, but the geopolitical events pushed gold so high. I mean, I just couldn't believe it. Now, remember, this has come from the beginning of December. It's it's rallied sort of like $80, $90 or something. So to see it accelerate even further was extraordinary. But actually, when the event happened on Tuesday night, Wednesday morning, by the time Trump had said, no, everything's fine, we're not taking any action, that's the end of the matter, that's effectively what was said. Gold came crashing back down again. So having hit 16.11, I think we closed down on the lows of the day, and it's sort of been treading water since then. But sort of what you'd expect, geopolitical event that turned out not to be a geopolitical event. So the de-escalation in the Iran-US situation resulted in a significant fall in back down in gold, which was, I think it looks a bit toppy. It's done so much in the last 4 weeks anyway. So.
Big resistance level on the weeklies. We just closed just underneath it on Friday.
That was at 1594 was the level.
Yeah, there's 1563 is quite a big pivot on the weeklies. We closed around 62.5, so only just, but just is enough. And here we are again a little bit lower today. So big level.
Yeah, it's definitely showing signs of rejection for sure.
Okay. Right, so I think that's enough for last week. Let's have a quick look and see where we're at for next week then. So what don't we know yet? Let's have a look then at the calendar, Jerry. Let's see what's going to be piquing our interest for the week ahead, shall we?
Okay. Yep.
Let me just bring the old browser up, and we'll get the Forex Factory calendar there. So. Is it worth a quick recap on last week? We had non-farm payroll last week, of course.
The non-farm payroll. It looks like it was a poor number. Sure, they revised the previous one down, I think 10,000 jobs, and we missed on December's jobs by another sort of 17,000, but it's just not enough really to worry the markets. If it was a real bad number, I expected a weaker number anyway because it was such an outlier last month. I mean, 266,000 or revised to 256,000. That was about 80,000 more than expected. So this is not a concern to the markets at all. So nothing really to upset the markets last week at all.
Yeah.
And all the seasonal trends at this time of year are very much coming into play, which is normally very positive for equities.
So really, overwhelmingly green numbers, better than beating expectations, apart from non-farm, which was probably a little distorted from the previous month. So
not bad enough to do anything.
A lot of good stuff. Yeah. Okay, what about this coming week then? So here we are, 13th of Jan. What are the main things to be looking out for?
Not a hugely busy week again, actually, but we've got inflation data at both sides of the Atlantic. So we've got US inflation data on Tuesday, which remains fairly benign. We look at the core data, which is the one that excludes the sort of more volatile food components, but 0.2%. I think the Fed is probably hoping or praying that inflation will pick up.
Yeah,
because that's sort of what's needed there. Anyway, but with low inflation, it does mean that when the Fed wanted to cut rates, they could cut rates knowing that it didn't matter about inflation. That said, obviously the Federal Reserve are on hold now, so there won't be any rate changes for a couple of meetings, if not more.
Let's just explain that relationship with inflation and interest rates, Jerry, just very quickly.
Yeah, so inflation, if inflation starts to tick up, they have to put interest rates up to slow down the economy. So if inflation gets above a target area that the bank are targeting, they will push interest rates up. It's a bit like a damper, so it's a bit like a brake on the economy. Likewise, what we've just discussed regarding the UK, if the economy starts to slow down, and it's not just inflation that's the concern, but inflation is prices, and price stability is the key mandate for all these central banks. But they do look at other stuff, especially in the US, look at employment. But there's just no inflation. It's extraordinary with such a tight labour market, with so many.
Yeah.
If you went back 30 years and explained what this market is like now, and asked someone to think what would interest rates be, they'd tell you 10%.
Yeah, they wouldn't believe it, would they? They absolutely wouldn't believe
record low rates in the likes of Europe and Japan, with close to record low rates in the UK, and rates tumbling in the US. It's an odd set of circumstances, and I think this is still a hangover from the great financial crisis.
Yeah, absolutely. One big thing for this week, we're going to be talking about the US and China potentially signing first phase of their trade agreement.
Yeah, that's right. It's been talked about for so long. Well, talked about the actual signing, but also the whole negotiations had a rather sort of bumpy way throughout last year. And I think the markets are actually a little bit too comfortable with the idea that certainly this first phase, or what's called the preliminary trade agreement, that will be signed on Wednesday. So that's a done deal.
Yeah.
And Trump has already announced that when this is signed off, then phase 2 will begin, and that's when the games and the threat of more tariffs, the whole routine, that will all start again.
Groundhog Day.
Yeah, and I think the market's a bit too confident, and
seems it, doesn't it?
I just think they're underplaying the risk that the negotiations may well falter at some stage.
But not only that, but of course once this is signed, people are then holding up because it's going to be signed. It's then signed, and then maybe there's no more good news in the post.
Well, that's interesting. Yeah, so then you're now focusing on something you hope will be good news, but you're not sure.
Yeah.
But I think it's. When Trump says, we've had our first chat at the second phase and it hasn't gone particularly well, so I'm going to slap on these following markets will swoon and then rebound. It's that sort of gig, really.
Yeah, absolutely. Okay, and then do we pay much interest to the Chinese GDP Friday?
Yeah, it's still important, but the problem with the data is that it's from the Chinese state, and if they say they've got a target of 6%, they will deliver 6%, even if that's not the number.
Or you skeptic.
It's not true, but that's actually there's one thing we haven't mentioned as well is the CPI data. Well, we mentioned the 1.5%. It is a lot less than a target rate. That's something we should have mentioned in the UK. It basically means there's no problem preventing the Monetary Policy Committee from cutting rates in the weeks to come.
Target rates, what? 2%?
2%. Yeah. But it's well entrenched below 2% now, and I think since the election, I don't think that the economic data in the UK has been particularly brilliant. And I know retailers, the whole shopping business has not had a good run up to Christmas and beyond, and look at the results from the likes of John Lewis. It's a bit worrying, and I think that's the reason why a lot of these MPC members have come out and said that they contemplate cutting rates now, which as we know is weakened sterling.
Okay, any other highlights to discuss?
Well, we've actually got that number coming out on Friday, which is the retail sales data from the UK, so plus 0.8%. Wow, I just don't know. That's for December. I've got a feeling it will be less than that, but that's what the market consensus is, plus 0.8%. But you think, reading between the lines with all the poor trading performances that have come out, I can't think it's going to be that brilliant.
Yeah. Well, they clearly didn't have my wife doing their spending, that's for sure.
Nor mine.
Right, good. Jerry, that's great. Thanks very much for all of that.
Okay.
Okay, so in this week's Defining Trading, we're going to take a look at something called initial margin. Now, initial margin when you're trading something called a derivative is the margin that you require, the amount of money that is required on your account in order to be open a particular position. So for example, a lot of people are more familiar perhaps with buying a home. It could be that when you buy a home, you have to have, let's say, a 10% deposit in order to then get a mortgage to then pay for the rest of the house. Do you see? In which case, your initial margin would be your 10%. That's the amount of deposit you've got to put up to be able to buy a house in the first place. Trading derivatives, spread bets, CFDs, futures is similar in that regard, packaged in a slightly different way, but your initial margin is the amount of money that's required on your account in order to open a position. Let's have a quick look at a particular broker's platform. We look at markets.com, have a look at some of the leverage, the margins that are available there. Starting off with looking at the indices, you get various margin rates or various leverage abilities depending on the market, which is really based on volatility, guys. Okay, so the more volatile the market, generally the bigger the margin requirement there is, because it's a riskier market. It's going to move faster and so on. Potentially the risk of a big move is greater the more volatile the market, you see. So in which case the broker wants to cover itself. It wants to cover itself by asking for more of a deposit from traders, just in case something goes a little bit fast and goes a bit haywire. So, broadly speaking, in terms of your initial margin, what you're looking for is a percentage of the notional value of the trade. For example, with an index, you're typically looking at around a 5%. So what, 20 to 1 leverage there on a lot of the major indices that one might trade. So for example, if we looked at the UK 100 that's a margin of 1 to 20. So if you've got £1 on your account, you can buy £20 worth of FTSE. That's a 5% margin requirement, basically. So in other words, you take the price of FTSE, let's say it's at 7,500, so 7,500 for ease of reference, divide that by 20, and then that will give you the margin requirement for that trade. Or times it by 0.05, which is all 5%, which gives you the amount of margin that's required in order to open that trade in the first place. We'll talk about maintenance margin in future sessions, but effectively that's what's required to open that transaction in the first place. 20 to 1, 5%, same basic thing. FX is different. You know, again, brokers can kind of charge what they want, subject to ESMA and their regulators' rules. But again, with foreign exchange, you've got a bit more money you're allowed to leverage with that one. So the margin requirement in percentage terms is less. That's again down to volatility. FX generally moves more slowly than stock indices. Okay, so 30 to 1, that's around 3.3% margin is required. So you could take the price of $, times it by 0.033, and that's the amount of money that will be required in order for you to open that a pound a point transaction on there. Okay, so the 0.033, so 3.3% of the notional value of the transaction, basically there. Pound again, 30 to 1, 3.3% margin. Similarly, you can look at equities or stocks that tend to have around a 20% margin requirement, so 5 to 1. So if you have £2,000 on your account, that's the 20% margin, you can then buy £10,000 worth of stock. Do you see? So again, just like the house analogy, if you want to buy 100 grams worth of house and you've got a 10% deposit requirement, that's the same thing. That's 10 to 1. Stocks, 20 to 1 there. Commodities vary a little bit. Often for markets like sort of gold, you're looking at 20 to 1. Sometimes they're 10 to 1. It varies a little bit depending on the broker and depending on the region you're in, and also the volatility of that particular instrument there. Okay, good. Well, hopefully that's helpful. And by the way, if there are certain terminologies that you would like explained in our defining trading section, please make sure you send them through. So send them through to info@trend-signal.com and then put podcast in the subject line. And any other questions you might want us to go through for any material you want us to cover, these are ultimately your sessions and they are for your benefit. So please do send those requests through. That's great. Thank you very much for your help with all of that, Jerry. That's great. We'll look forward to catching up again next week. This section, though, what should we be trading? In this section, I'm going to give a run through some of the key markets, some of the live charts, and what's looking ripe, what's interesting, what's hitting key levels worth trading at the moment. So let me just bring my charts up, and we'll have a quick look through some of the opportunities there. Let me just bring up a chart. First of all, we're going to take a look at gold, which really has been, as we discussed with Jerry earlier, been quite a big move. In fact, since that buy signal back at the beginning of December, really a massive move up there, well over 1,000 points or so. Good $100-130 rally since then. Come back a little bit here. So what are we thinking? Well, we talked about resistance last week. We talked about a major resistance level. Just tighten up the weekly chart a little bit, and then we can start to bring in some of the resistance levels. This is what I was talking about last week, because if you're watching the screen here, you can see around that sort of 1563 level there, a couple of pivot points from that major level of support. That support arguably now turning into resistance back from 2012. We're hitting back to those numbers there, hit support here off that number there, a number of times back in 2012, 2013. Here we are nudging that number just shy of it towards the latter part of 19, and here we are again here going higher, but then closing back just below it, and that's important. Does it get above? A bit like that game Whack-A-Mole. Does it get its head above, and then is it whacked back down? Here we close below that 1563 level, around 1562.5, something like that. I think we closed at there on the weekly. Now we've come off again today. So I think that that's a pretty crucial level from there. So we're pausing at the moment, really, and looking for short trades off this level if we can see that. So what we're going to do is quick look at the daily chart. It's starting to look like a potential sell trade with very overbought on the trend signal line above that magic 75 number there. That's going to start, that's turning down already. Price, this line that kind of cuts through the candlesticks, that's solid green. That's going to start to turn red potentially. The longer prices remain below this green line, it's going to turn it red. And we're going to be looking out for sniper signals as well with the right type of reversal pattern. That big Fibonacci pivot there coming in 1581. So we're starting to build the hallmarks of a potential sell trade. What does it mean from there? Well, do we expect a massive move down? Well, look, the longer term trend is up. Yes, we're at the top of the natural trading range, but actually, as far as targets concerned, we're looking around that sort of 1509. So if we do come off, we're looking around 1509 for the market to certainly start to pause. That's the resistance back from the beginning of November last year. So we're talking a few chess moves ahead, but keep an eye out for your sell trades. I wouldn't necessarily expect a massive fall though on gold. Probably a few chess moves ahead down to here, and then probably finding support maybe with a view to rejoining that longer term uptrend. Looking through then to FTSE. Been interesting really with the FTSE there. It continues to be flattered around that sort of 7600 level. 7695 on the monthly is a major level. We can see that number there back from sort of mid 18 there. We're hitting that number a couple of times in the past. We're a little bit away from it at the moment on that, as I said, as we're pausing on the market there. So what are we looking for here? We're looking for a couple of bits. There's around 7800 on the weekly, 7695 on the monthly. In terms of this congestion here, those are the numbers to be looking for the upside. On the downside, we'd be looking for this break below this sort of number here. That's 75, around 75.23. If we can see ourselves breaking below that level, I would expect us to move relatively quickly down to this level of support here, because often what you're going to find is if people are buying up here, their stop losses are going to be below these lows at around 75.23 on the FTSE cash. What that would mean is stops will be taken out, market would gather speed, and we should then move to around that sort of resistance level back from November last year. That may well form into support for that first target there. A break of that level could see us down to that sort of 72.20, 71.65 level as well. So keep an eye out for those levels too on the FTSE there. So at the moment, congested, so look for breaks above 7,700 to take us to further highs, or look for breaks below 75.23 to take us down to that sort of 74.20 level. As for the pound, we talked about this earlier with Jerry. We looked at the way in which price is coming off. The pound coming off there as we start to talk about those MPC voters starting to a little bit more of a vote, a little more of an appetite for rate cuts, hence the fall there. Now, what about the longer term? It's hard to go past really the support levels we've got from around this sort of level there. So that sort of 129.40 level there, 129.50. That looks good for support. Couple of pivots at around that level. A congestion of pivot points really does tend to lead to stronger support levels. What we'll be looking for, just like we found the test there, is from there looking for new moves back to the upside there. So will we get a sniper buy? Will we get a continuation buy? We'll have to see as it comes through. But certainly looking for that retest down to that sort of 129.20 level, and we'll see where we go really from there, guys. So those are the major markets we're going to look at for this week. That's gold, FTSE, and the pound. Okay, so that's pretty much it for this week's podcast, everybody. Hopefully you found it a really useful session. We've been talking about the markets, what to look out for, lots of analysis in there, and also boosting your trading education as well. But it doesn't have to stop with this podcast. What you can do is tune in to one of our live trading events. And in these events, we actually teach you our favorite trading strategies. And you can find out more about booking a free place and reserving a free place in one of these live events by going to our rather strangely named URL, bit.ly, so bit.ly/learnts, okay, bit.ly/learnts, and then you can come along, book in for a free place in one of our live events. We're doing 4 live trading events every week now where you can tune in. We'll teach you a strategy, we'll apply it to current markets, and you're going to learn a lot of great stuff about the trading as well. So I'll be trading FX, indices, commodities, and all sorts of other great stuff in there as well. So make sure you get yourself booked in for one of our upcoming events, please, guys. Remember that link again, bit.ly/learnts. Otherwise, how can you access the Trend Signal podcast? You can do this in a number of ways. Everybody, we do this weekly on Mondays. You can listen to the live cast by registering on our site, which is trend-signal.com/trendsignal-blog. A bit convoluted, isn't it? We need a shorter link for that one, I think. Let me say that one more time. trend-signal.com/trendsignal-blog. Or you can search for the Trend Signal podcast on iTunes, SoundCloud, Spotify, and YouTube. Otherwise, guys, have a great week's trading, and we look forward to tuning in for the same this time next week. All the best, and bye-bye for now.